Welcome viewers. Today we shall discuss the theory of factor pricing. But before talking about or discussing about the theory of factor pricing, it is essential to talk about theory of production, because the root of the theory of the factor pricing lies in the theory of production. So we have to talk about production. Production function. Production function specifies the maximum amount of output that can be realized by using each combination of quantities of inputs or factors of production. Input is defined as anything that a firm uses in its production process. Main inputs in a production process are land, labor, capital and entrepreneurs. It is very clear from this production function, which is a technical term used to show production process, that the entire production process is not simply talking about the product market, but it is how output is produced with the help of different inputs or factors of production. Now the question is that what is production function and why production function is essential to know the theory of factor pricing. Now production function is the maximum amount of output that can be produced with the help of various combinations of inputs. So what are inputs? Inputs basically are the factors which are used in the production process to produce this maximum amount of output. Now the factors of production or the inputs, the main factors of production are land, labor, capital and entrepreneurs. Now in short run, inputs can be fixed inputs whose quantity cannot be changed during the time period under consideration, like land or capital, or variable inputs, an input whose quantity can be changed during the relevant period, like labor. But in long run, all the inputs or factors are variable inputs. Now short run and long run are the two most important periods which play a very important role throughout explaining all the economic theories. In production also, and talking about factor pricing also, we need to keep in mind that whether we are talking about short run or long run, because in short run the time period is very small. So the variability of these inputs or factors of production are limited. Like labor is the most variable factor which can be varied very conveniently anywhere at any moment of time, but capital is not. So in short run, land, capital, they are kept constant. But in the long run, because the time period is long, a producer can vary all the factors of production very conveniently. A simple production function is denoted by y is equal to f ln k. That is, y is a function of labor and capital. It shows how much output y the economy can produce from different combinations of labor and capital. So here we are representing the production function in the functional form. The functional form shows how the total output produced is related to the various inputs. So here y is for maximum output produced, and L denotes labor and K denotes capital. While when we talk about this production function, as I told you, in short run we keep a bar on K to show that capital is constant and labor is increasing unit by unit on that fixed factor of production. But in long run there is no bar on these inputs and factors of production. Now we will show you the production function or the graphical representation of the production function. Now as you can see from this graph that on the vertical axis we are taking output represented by y, on the horizontal axis we are taking labor, the rate of input or the units of labor you can say. Now as the graph is showing that initially with the change in the rate of input or with the additional 1 unit of input, the output is changing. Initially it is changing at an increasing rate. After this point it is changing with a decreasing rate, and then at the top the total product is maximum. After this point, if we still keep on increasing labor, then the total output will decline. So, this entire production function is showing you that how hiring various units of labor, total output is changing. Now, we shall explain you that how rent, wages, interest and profit are determined in the factor market. Factors are bought and sold in the factor market, and the prices in this market are known as factor prices. These inputs are rewarded for their contribution into the production process. The reward for land is rent, for labor is wage, for capital is interest, and for entrepreneur is profit. So, as we already talked about that how these factors of production, they contribute, but why are they contributing? They are contributing in return of something which they are getting, because they are providing their services, so they must get some reward. So, there are, as I told you, there are 4 factors of production. So, when services of labor is provided, they are paid in turn in the form of wages. Similarly, rent is the reward for use of land, interest is the reward for use of capital, and profit is the reward for use of entrepreneurship. The next thing is distribution theory, and how distribution theory is related to theory of factor pricing. The income earned through the sales of the product or the remuneration for service is distributed to the owners of the factors of production. The theory which explains determination of factor incomes is known as the theory of distribution or the theory of factor pricing. Now, as I told you that there are 2 markets. Product market is a separate market where product is bought and sold, and related to that there is another market, that is factor market. So, the income earned through the sales of the product, like when product goes into the market and it is being sold, the owner of the product or the seller of the product is getting something in terms of the income. Now, this income, earned income, is distributed among various factors of production. That is why the theory is named as the theory of distribution. Now, basically in economics we have 2 branches, micro and macro. So, when we say income earned in aggregate or macro, we say theory of distribution, and when we make it as a part of the microeconomics, we say that it is the theory of factor pricing. Now, factor pricing and marginal productivity. Distribution theory is a special case of the theory of prices, and the prices of factors of production are determined by the supply and the demand for factors, just like the product market. There are 2 theories of distribution, micro and macro. Macro deals with distribution of national income and micro with individual distribution of income. There is a product market, and supply and the demand forces, they determine price of the product in this product market. Similarly, but related to this, there is a factor market, and supply and demand forces of the factors, they determine the price of that particular factor or whatever factors are there in the process of production. As I told you again that there are micro part and there is a macro part of the economics. So, in macro, basically when the theory of distribution is considered, it is regarding the national income, income of the entire economy or income occurring in the entire economy. On the other side, when it is applied to theory of firm, it becomes theory of factor prices. Nature of factor demands. Now, factor demands are derived demands. Demand for input depends on the demand for output or final product. Firms demand inputs because inputs permit them to produce a good. if demand for any commodity increases, the commodity demand curve shifts outward, and related to this, demand for input will also increase and the input demand curve will also shift outwardly. Now, the nature of, before talking about how prices are determined, now the next question is, what is the nature of factor demand? The nature of factor demand or the factor demand depends on basically two things. The first one is that the demand for a factor is a derived demand. It is not a direct demand, it is an indirect demand. Why indirect demand? Because the demand for factor, all the factors of production, specifically labor, it depends on how product is being sold in the market. The demand for final product is increasing in the market. Simultaneously, the demand for the inputs that are being used in the production of that particular good will also increase. So, if there is an increase in the demand for product, the demand curve, which is a downward sloping curve, it will shift in an outward direction. Similarly, the demand for any factor of production, depending on the demand for the product, will also shift outward or inward. The inward and outward shift of the demand of the factor depends on the inward and outward shift of the demand for the product. Now, we will talk about what are the factors or what are the factors which determine the shifts in the demand curve. Shifts of the demand curve, there are three main causes of shift of the demand curve: changes in price of goods, changes in supply of other factors, changes in technology. Now, first we will talk about changes in the price of good. Take for example, the income of the consumer is increasing, and as you all know that with the increase in the income, the demand for any good, usually it is a normal case, for normal good, the demand for that particular good will increase. So, the price is falling and the demand is increasing of the product. So, obviously when demand is increasing, the producer, to earn profit, to earn more income, will produce that particular good more. Related to that, the demand for the inputs will also increase. Changes in the supply of factors. Now, supply of factors is very important factor, because it is simply not demanding the factor of production. It is looking at whether the supplier, whether it is the supplier of the labor or the capital or anybody, would like to supply it more whenever it is required or not. So, whenever, take for example, the demand for product is increasing, the supply of input will also increase. Usually in normal case, it will increase. And the third case is changes in technology. Another important part, that how changes in technology, because whenever technology changes, the production function, the entire production function which we talked about, it will also shift in an upward direction or in downward direction depending on the level of technology. Now, it depends whether, or it depends on that how technology changes, depending on that the demand of various factors would be affected. If, take for example, there is technology improvement in the economy, then automatically with the given amount of labor, the supply curve will shift outward or in inward direction. So, these are the three factors basically which affect the product market, and hence they affect the factor demand curve. Another important nature of factor demand is interdependent demands. Now, factor demands are interdependent demands. Production is an outcome of various combinations of different input. It is a teamwork. For example, a chainsaw cannot cut a tree itself. It has to be used by a labor. Thus, productivity of one factor depends upon the amount of the other factor working with it. So, another very important nature of the factor demand is that the demand for all the factors of production, they are interdependent. They are dependent on each other. The example, as it is given in the example, that a chainsaw cannot cut a tree itself. It has to be used by two hands, or it has to be used by labor. Without being used by labor, it is of no use. So, demand of one depends on demand for the other factors of production. Another important thing is that the total productivity of one factor depends on the amount and another factor of production is being used with that. So, being used with the labor, the productivity of the chainsaw has been increased to multifold times. Marginal productivity of factor pricing. The key to all factor incomes lies in the concept of marginal product of different factors of production. Marginal product of an input is the extra output produced by one additional unit of that input or the physical unit of product per unit of additional input. Marginal physical product is another term used for marginal product. Now, we talked about factor incomes, we talked about production function, but basically what is there in the factor market that determines how much wage of any factor of production will get. This how is answered with the help of marginal productivity or marginal product or marginal physical product. Now, what is marginal productivity? Marginal productivity is a concept of productivity related to the total productivity. It is, as I told you, that in production function, step by step we are increasing units of labor. So, with every increase or additional or extra unit of labor, how much output is changing is defined or is explained with the help of the concept of marginal productivity. Now, as I told you that because here we are talking about physical units, so that is why marginal product is also called as marginal physical product or MPP. Now, we shall discuss the graphical representation of the marginal product. This is on horizontal axis we are taking again units of labor, and on the vertical axis we are taking marginal productivity of labor or units of output. Now, this graph, which is a downward sloping graph, it directly relates to the production function or the total productivity graph. So, as you can see, as the units of labor is increasing one by one, the marginal productivity or the additional output added by that factor labor is coming down. So, it is just like a normal product demand curve. This is a downward sloping demand curve. Next graph will show you the relationship between production function and marginal productivity of labor. It is simply that on the horizontal axis we are taking labor. Now, another additional unit of labor, one more unit of labor, and now output is being reduced. So, as you can see that with every additional unit, marginal productivity is coming down and total output is coming down. As more labor is added, marginal productivity of labor is down. Now, why we are discussing that ultimately the wage rates that are determined in the factor market are based on this marginal productivity. All the wage earners or the laborers, they are paid on the basis of this marginal productivity of labor. Now, marginal revenue product. Demands for various factors of production are derived from the revenues that each factor yields on its marginal physical product. This additional revenue produced by an additional unit of input is called marginal revenue product or value of marginal product of labor. It is calculated as the marginal product of the input multiplied by the marginal revenue obtained by selling the extra unit of output. So, after talking about marginal product, the next important concept for the determination of wage is marginal revenue product. Now, whenever a producer is hiring a factor, how much revenue is being earned by that factor of production, his or her remuneration depends on that amount of revenue added. As it is very clear, and because we are talking about revenue, again the concept of marginal revenue is more important rather than the concept of total revenue, because here we are talking about every additional change of labor. So, when physical units of labor are changing, how these changing physical units are increasing or helping an increase in revenue. So, this concept of revenue multiplied with marginal productivity is actually called as marginal revenue product, and this concept of marginal revenue product we are going to use throughout to determine wages in the perfect competitive market, to determine wages in the monopoly, to determine wages in the monopsony. So, different market structures we will talk about. So, today in this lecture we talked about production function, the factors of production used in the production function, the nature of demand of these factors of production, that is their derived demand and their interdependency. Then we talked about marginal productivity and marginal revenue, and then how marginal revenue and marginal productivity combinedly gives us marginal revenue productivity. I hope you enjoyed this lecture. Thank you.